and you have $7 million of investor money sitting in there. I literally moved out to the property for a month and a half, moved from San Diego to Texas to work with the on-site management to make sure they got their ass in gear. And we threaded that baby across the finish line because I was not letting that thing go. I said, there's no way in hell. I said, the only thing keeping this thing from getting to the finish line is effort.
All right, guys, welcome to another episode of The Report. Today, we are in the studio here in downtown San Diego, and I got a special guest who I've actually connected with through our Beers and Deals meetup here in San Diego. And I'm super intrigued by this individual. He owns over $100 million of apartments and mobile home parks. I got my man, Justin Brennan. Justin, welcome to the show.
What's up, man? Thanks for having me.
Yeah, dude. It's a pleasure to have you on the show. I don't know a ton about your story, so I'm actually super excited to dive into it. But man, you're right up the street. You said Scripps Ranch, huh?
Scripps Ranch, La Jolla, anywhere coastal San Diego. So we're both local. And you were telling me you're San Clemente, so we're all Southern California boys.
Yeah, San Clemente is where I grew up. That's why I love San Diego. I'm like, I'm an hour from home where my family is, but it's like not too far, not too close, so.
Question, do you surf?
Okay, so San Clemente, growing up there, you either grow up surfing or you grow up skateboarding. And for whatever reason, it was never both. But I grew up hanging out with the skateboarders and I grew up skateboarding.
So skate parks.
Skate parks. We would build skate ramps and rails and all sorts of stuff on our cul-de-sac as a kid growing up. And then I got into snowboarding at a later age, but a lot of those skills kind of transition over.
That's cool.
You're a surfer.
I'm not. I was going to ask you because we're both Southern California people, and
gotcha.
I have a shark story with surfing, so that's why I don't surf. But it was here actually in San Diego.
What
probably
happened?
20 years ago. I was out in Pacific Beach, right near the pier, around 5 p.m. in the afternoon. I was with two other buddies. We were sitting there waiting for the next set to come in, and the sun was just perfect, right, where it's hitting the water, and we're waiting for the next set. Next thing you know, about a 15-foot shadow.
Whoa!
Goes right underneath all of our boards. And we all sit there looking at each other. We all knew what it was. Nobody had to really say anything because we knew it wasn't a seal, and it sure as heck wasn't a dolphin. And we all put our hands up. We were longboarding, throwing those babies around. Nice slow paddle right back into shore. It messed me up clearly. But I call it womping, right, or bodyboarded, and I kiteboard now. So I love kiteboarding.
Dude. Oh, so how common is the shark thing when you're out here surfing in Southern California?
They're out there.
Yeah.
That's what I hear. I have friends that surf. Obviously the odds are completely in your favor, but it's all unfortunately in my cabeza now.
Dude, so. I can imagine. I would be creeped out too, man. I don't like sharks. But the kite surfing, that's unique, and that's something
legit.
that I've been always wanting to get into. I know how to sail. I have a background in sailing, and so, if you combine sailing and surfing, or, with my skateboarding background, snowboarding background as well, I feel like it would be kind of a natural progression for me. So I've always wanted to do it. I'm always intrigued watching these guys on YouTube.
You would love it.
Tell me where you go.
So I started learning in Fiesta Island, San Diego, during COVID. I'm like, I need to pick something new up.
Yeah, that's the perfect time to learn.
Got taught, trained, and it's wild because I grew up wakeboarding. And if you picture it, you're essentially driving a boat and surfing at the exact same time.
Mm-hmm.
So the hardest part is learning the kite. But with your background in sailing, you understand wind, right? Upwind, downwind, these patterns of wind. So you'd probably pick up on it a lot faster because you got to learn to fly that kite. And once you figure that out, then it's, rest is...
How much wind do you need ideally? Because I know the air here in San Diego is very light compared to other parts of the world. But there's a lot of days where the wind never even hits 6 knots.
Right.
So what's the ideal wind here, minimum?
12 to 20 knots is kind of where when I have a little app, like the wind app, that shows you where all the wind's at and where it's hitting. And then you're going to use a 14 to 18 meter kite. So it's a little bit bigger kite than if you were in some higher wind areas like Hawaii.
Gotcha. So I see these dudes out in South Africa where it's gusting 45 every day.
They're using a tiny kite.
Well, how big is that kite?
6 to 8 meters.
Wow, that's
maybe.
crazy.
Mini kites, because they're launching.
Yeah. So, dude, I'm super intrigued with your story here. But first, I got to ask you, man, what is the biggest difference between mobile home park investing and multifamily?
Well, with mobile home parks, obviously you're dealing with a different profile, right? Because it's different affordability and stuff like that. The kind of the rule of thumb with any mobile home parks is you want 100 pads or more. You want them within 5 miles of a Walmart. You want them in a town of at least 100,000 population or within distance of a population of 100,000 or more, because you need that demand supply. Whereas with, multifamily, I feel like as long as you're in good job centers and you're in the top 75 MSAs in the United States, you'll be able to do well. But I'd say the biggest difference is just your tenant profile. Well, and the fact that I guess, with mobile home parks, you own the land. You're basically a landlord, literally, and you're renting, the mobile home to the person, or they buy it from you and they own it. So they're just renting the space.
Ideally, do you want to own the homes on the park as well, or do you want to just have the tenants own those?
I just want to own the land.
Yeah,
it's like an RV park.
Why is that?
Because you don't want that liability with the mobile home. You might as well let them own it. Plus eviction purposes and all that other things. They can control that liability. You just want to be basically land lease in a way on the mobile home parks. Much more efficient that way.
I can imagine your expense ratio
much lower,
goes way down if you're operating that way.
Yeah, because you're keeping everything pretty lean.
No repair maintenance, right?
Yeah, because you're renting a pad.
Yeah,
a land lease.
And I know they're not building a ton of new supply with mobile home parks. Are there any areas to where they're building more?
Not so much building them as much as it is there's a ton of them out there in different areas. A vast majority are still mom and pop. Did you know that one of the largest owners of mobile homes in the United States is Mr. Warren Buffett?
No, I did not know that.
He owns 21st Century Mortgage too, which actually produces all the financing for the mobile home parks in the United States.
So I heard that Warren Buffett has some part ownership in a company that manufacture the actual homes. Mm-hmm. But you're saying he owns a ton of mobile home parks as well.
Yeah, through funds and stuff. Yep. The mobile homes, you said, the mortgages, the financing for them through 21st Century Financing. Yeah. But then he also has access to the mobile home parks. Yeah.
I guess it makes sense. I mean, if you're manufacturing a lot of these homes, you probably have inside scoop on a lot of these deals as well.
Big time.
Yeah.
I mean, all around the country. I mean, you can imagine Mr. Warren Buffett. I mean, he's got all the people, working for him, but that guy is the quintessential investor, isn't he?
Yeah. Everyone knows him as like the quote unquote, like stock guy, right?
Yeah.
Wall Street guy. But no one really talks about him owning real estate.
And a ton of it too, but it's quiet, right? Mm-hmm. He doesn't talk about it because he's kind of the guy that goes in and, operates companies, right? Or has a piece of those companies and helps them, take it to the moon.
Yeah. So what kind of like mobile home parks do you guys target? And then typically what does the business plan look like from a macro perspective?
So like I said, 100 pads or more. That's so you get the volume and the economies of scale. You want all the utilities kind of controlled on site to where, city utilities mainly. And you're a owner of the land. So you're leasing the pad back to the tenant. And that's your main focus. And then you look at other parameters for population growth within Walmart. It's kind of like a funny joke, but if a Walmart's within 5 miles of your mobile home park, you're pretty good for weird reasons.
And what are the reasons behind that?
It's commercial based and it's job centers, because that if you have a Walmart, right, and then usually the population, because Walmart has enormous amounts of data, right? Mm-hmm. So when they're doing all their research for how they're going to put a Walmart into a town, they know all the parameters. So that's kind of your tenant profile.
People that shop at Walmart.
Yeah.
Okay. Interesting. What's like, I know like median household income in the U.S. is kind of in that $65K range. Mm-hmm. What is ideally in these mobile home park areas? What kind of median household income are we talking?
About $45,000.
Okay.
On average. Even for the apartment stuff, depending on the market, north of 55,000, median household would start to, classify a decent apartment market.
Mm-hmm.
So,
dude, I love that, man. So what do you guys own today? Kind of give me like a snapshot of what you guys own. And then I do have a ton of questions about the multifamily side, but what do you guys own today?
About 520 units, give or take, in 5 different states, about 110 million plus in assets total. But we started with one condo, man.
Really? Damn.
2010 financial crisis, Murrieta, California. We bought one condo, $100,000, put $25,000 down, got a $75,000 loan from Wells Fargo, turned that into a duplex, then a triplex, and a couple fourplexes all around San Diego. And then from there, we got into that 5 to 10 unit space, quote unquote commercial.
Mm-hmm.
And then we're like, gosh, we need to scale, but we can't really do that locally because San Diego is pretty expensive. So we need to scale our money out of state. Well, that brings a whole nother set of logistics. How do you manage it? How do you logistics, operations, construction, on and on and on.
Mhm.
And so I spent a decent amount of time from really 2018 all the way till now setting up infrastructure in states like Missouri, Oklahoma, Texas, Tennessee, Alabama, Arizona, Nevada. And so now we have assets in those states because we went in and, 3 to 6 months in advance of buying any properties, we're setting up PM crews, construction crews, brokers, all kind of the infrastructure, the team on the ground, to where that way it feels super comfortable and we know the play. We know the good areas, the bad areas. Where's the path of progress? Where's the new development?
Now, when you just mentioned all these states, did you go in and identify multiple markets within those states to set up these teams, or did you just pick one market and say this is the one market, such as Phoenix, Arizona?
Oh, gotcha. Within the state. Is that what you're saying?
Yeah.
Yeah. So Kansas City, Missouri was a great one. And I had no idea. I was actually at a conference. Do you know who Dave Lindahl is?
Yeah. He
does
wrote
like RE Mentor and all that stuff?
Two of my favorite books. One of them is Emerging Real Estate Markets.
Yeah.
And the other one is Multifamily Millions.
Yeah.
Multifamily Millions is great because it kind of teaches you, it's like a good intro book to like commercial real estate, and all those principles apply to all asset classes. It's not just multifamily, but like the idea of buying a underperforming, tired commercial deal, improving it, renovating it from the outside,
value add
from the outside in, and forcing your equity that way. But those same principles apply to the hotel stuff that we do, and emerging real estate markets. I mean, that's great just to kind of understand what moves pricing in different real estate markets across the country. But anyway, so Dave Lindahl, you were connecting with?
Yeah, I went out to a conference in 2018 in Boston, Massachusetts, and met, there's thousands of people out there, met a bunch of people, connected, tried to identify markets that we were interested in, ran into a couple different brokers, and this guy said, hey man, you need to come see Kansas City, Missouri. And I'm like, Kansas City? He's like, just trust me, come to Kansas City. And I said, okay.
Mm-hmm.
So I decided I was going to fly out there in January, negative whatever degrees, snowing. I think that's when the Chiefs were playing the Patriots in one of the AFC Championship games.
Did you go?
I'm a huge Patriots fan.
Okay.
I did not get a chance to go to the game, but I get to watch the Patriots win.
Dude,
so I was happy with that.
I've gone to one game at Arrowhead before. I'm a Charger fan.
Okay.
But I went to a game there. It was the same thing. Wintertime, it was cold as heck. The fans are they stand on these styrofoam boxes on top of the concrete, and it kind of keeps your feet warm.
Oh, interesting.
But dude, nicest fan base I've ever seen. Literally, they stand up the entire game.
Yep.
Even during timeouts, they don't sit down. Great fan base, and super loud. But after the game, the Chargers won on a last minute drive. They won by 1 point, and it was late in December. It had playoff implications, and literally every fan on the way out was like, "Thank you so much for coming. Congratulations on your win."
That's the Midwest spirit.
Yeah, it was Thursday night football. So, they do the set down on the field.
Mm-hmm.
So we were all walking down to do the post-game set to go watch it, and all the fans were coming up.
Oh,
so they're all passing us in a sea of red, and they were like, congratulations. Thanks for visiting our town.
Could
I was
you
like, I've never
if you were in Pittsburgh or Philly or
yeah,
they'd be
there was
giving
four
you
of us all
the bird the whole time.
Yeah, 4 of us in our Charger gear, and I've never met such a friendly fan base. But anyways, we digressed.
That's great.
So you were saying Kansas City show up January.
Yeah, and I was blown away. So Kansas City reminded me when I saw it of San Diego downtown, early 2000s when the ballpark was going up. Cranes everywhere. So I'm like, holy cow. And then I get the lay of the land from the brokers. We're seeing where everything's at, path of progress, growth, development, blah, blah, blah. And he said, hey, here's kind of the areas you want to be. Here's where you don't, blah. And we ended up, our first out-of-state deal was a 27 unit and then 31 unit. Those have been phenomenal for us. And then started going into, Texas, started looking in Nashville, Tennessee, and Knoxville. Now we're in Las Vegas and Nevada with Rudy Medina. And then obviously I love the Phoenix market now that it's coming back to earth. But Arizona's a great market. So
what's the biggest asset that you guys own?
160 units in Las Vegas, Nevada.
Okay.
It's a brand new construction, Class A, that just completed. And we're moving it out of construction financing into permanent financing.
Gotcha.
And so that's a challenge.
And was that a new development for you guys, or you guys bought it after
ground
it was
up?
built?
Yeah, ground up dirt.
Nice.
So Rudy and his crew built that from ground up, and now we're bringing in new capital to replace the construction capital, and going to refinance it into permanent debt. So, but it's wild times in the capital markets, man. As you know.
How long does it typically take to lease up, 160 unit building like that?
12 to 18. I mean, it depends on time of year, right? But summer months, you're going to be doing, 10 to 15 leases a month if you're moving. So you figure something like that, and then you slow down in the slow seasons, like right now. So you figure at least 12 months.
Yeah.
Maybe 18 months total. So it just depends.
Yeah, that sounds about right. So you guys are doing, you were buying a lot of the smaller stuff. Are you guys kind of pivoting your strategy now and getting into larger buildings? If you love real estate investing, passive income, and tax benefits, but don't have the time, my company, Summers Capital, is buying boutique hotels right now. We source the deals, we renovate the properties, and we even handle all the day-to-day management, making it truly hands-off for our investors. If you want to learn more to see if we can help you, visit summerscapital.com/invest to book a call with our team. Again, that's summerscapital.com/invest. Now back to the show.
Yes, because the economies of scale, and that's kind of what we learned is, our first out-of-state one was a 27 unit and then a 31 unit. And I'm looking at it going, gosh, you can go get a 100 unit deal and it's easier to raise the money. And there's more people, the banks want to give you the money easier because the economies of scale are there. I mean, I ran into that with a private equity fund group, and we were trying to raise some money. And I said, hey, we need $3 million. And they said, Justin, like, we love the deal. We love you, but we can't give you 3 million, but we can give you 10. I looked at him and I'm like, so let me get this straight. I only need 3, but you're telling me you'll give me 10. They're like, yeah, just go find us a deal. Like, we want to invest with you. And that's kind of what triggered in my mind. Like, oh my gosh, like, we need to get into the bigger space, because now you're going to have a complex that's self-contained, its own management, on-site, payroll, leasing, maintenance, everything's self-contained, focused on that property, and the economies of scale go with it.
Yeah, dude, I love that you brought that up. You're exactly right. It's like, it's almost like getting lending for multifamily and the bigger deals, and we see this with the hotels as well, is easier. Yeah. You go get a smaller loan amount for a multifamily deal, and, dealing a lot of like regional banks, and they're going to want full underwriting and all this, paperwork. Or you go get a, Fannie Freddie agency loan for multifamily.
Non-recourse debt.
Non-recourse. They're not looking at your personal debt to income ratio. They're really just sizing up the deal based on 2 things: the experience as the sponsor,
and the DCR,
and the way the deal pencils.
Yep.
Yeah. And some of those loans are so, in terms of pricing, are very competitive too.
We just threaded the needle on one of our Texas deals, 121 units, and we had purchased it in December 2021. Hindsight now, peak of the multifamily market. Interest rates, they started to go rocket ship in March of 2022. Yeah. And so we went from a 4.25% interest rate on a bridge debt financing, right? Because we were going to buy it.
4.25% bridge.
Oh yeah. I mean, we're buying this. Everybody was there. Thankfully, we only had one of these, but we bought it. 4.25% interest rate, and, renovating the property. Business plan's perfect. Everything's going great. And obviously interest rates go from there to 9.5% on us. And so we're now rushing to try and get this thing refinanced, but we need to get renovated to have the rents high enough to then have a new valuation to refi. But we just had to do a huge $2 million cash in refi recently and buy down the debt and get us into a Fannie Mae loan at 5.49%. And we just got extremely lucky. Like, so lucky I can't even tell you, because literally a week after we closed on that loan, the 10-year treasury went berserk. And then you can see where it's at today. And so now you have a lot of these multifamily guys. I mean, I'm telling you, man, when Grant Cardone talks about a storm of brewing, he's looking at the same data I am. It's no joke. I mean, between coming up this year in 2024 through 2025, you have an enormous amount of commercial debt set to reset or need refinancing, coming to maturity, all these things. And it's just a question of who's too big to fail, who can get workouts, who can get extensions, because the refinancing is going to be very tough in this environment right now.
Yeah, and you know what? It really depends on who you talk to. I did just interview Robert Martinez, apartment rockstar out in Houston, about a month ago.
He's a buddy of mine too. I love it.
And we were talking about he just foreclosed on a $51 million multifamily note that he picked up in early 22. And so he was trying to see some of that stuff.
When you say he foreclosed on it, meaning he gave it back to the bank, or he? Okay, gotcha.
Yeah. It was a Freddie floater that he picked up in early 22, A-class deal. Didn't have a lot of value add component, but he said he switched over from in-house property management, which he's been doing this entire time, to third party. Right when he bought that deal, and he said they kind of ran that deal into the ground. And anyways, the lender wasn't working with them, and they ended up taking the property back.
Yep.
So I think there's going to be more of those to come. But, to Grant's point, you're talking about Grant Cardone. I mean, he was on this podcast telling me that he bought $1 billion multifamily portfolio in Fort Lauderdale in December of 2021, right before the rates went up on floating rate debt. And he said that
I'm shocked he did that.
He told me that he has not refied. He would have to bring tremendous cash in to refi right now, but he told me he told me he's just basically, from what I gathered, I didn't really dig in too much, but from what I gathered, he made it pretty clear that he is just basically covering that debt service right now with his own money.
Holy moly.
Yeah.
Yeah, I'm actually really shocked that he did that because he's relatively conservative on his underwriting and puts an enormous amount of equity into deals. And typically he's Class A fixed rate debt guy because of what he went through in 2008 and 9, which he talks about. He was very close to imploding. So I'm shocked that that's the case. But everybody's affected by it right now, which is why I said we got so lucky because had we not been able to refi and thread that needle on that deal, it's likely going back to the bank. You have $7 million of investor money sitting in there. I literally moved out to the property for a month and a half, moved from San Diego to Texas to work with the on-site management to make sure they got their ass in gear. And we threaded that baby across the finish line because I was not letting that thing go. I said, there's no way in hell. I said, the only thing keeping this thing from getting to the finish line is effort. And I said, what I'm not going to do is allow this thing because the on-site PM company doesn't want to get their head out of their you-know-what. I said, I'm going to show them how to manage this baby. So we went in there with their staff. We took it from about 82% occupied to 98.9, delinquency down to 2%, all the work orders under 10, all the future renewals in line. Boom. Got the thing right across the finish line. But that's what it takes.
Yeah. I love that you did that. And quite frankly, that's what it takes when things go south.
The loan brokers were floored. They were floored. The Walker Dunlap guys, they're like, Justin, we've actually used you as a case study because we've never seen an owner literally move on site to one of their assets to safeguard it. But I said, thankfully we only had this one in this predicament so I could focus. And I said, there was no way in the world I was going to allow $7 million of investor capital to go poof, which a chunk of it's ours. Not going to happen.
What kind of techniques were you utilizing that worked well?
Hyper proactive, aggressive, every day, hammering things out. Because it's 4 reports. I said, you can manage an entire, and Robert Martinez knows this very well because he's a very good operator. You can manage an apartment building if you focus on 4 reports. The availability list, the work orders, delinquency, and renewal list. If you manage those 4 reports on any apartment building extremely well, like white on rice, the financials will back it up and that thing will hum. But I said, if you don't manage those extremely close, like daily, then you'll start to see it suffer because those 4 reports will tell me where the property's at today and where it's going to be at 90 days from now.
Okay.
And if I can come in there and manage those things correctly, and it takes intensity, which is what a lot of these PM companies, unfortunately, I don't expect them to care about our money the way we do. I don't expect it, right? So if they're not going to, then I'm going to, which is why, the PM company got pissed. They didn't like that I was out there, but I said, it's not your money.
Yeah.
I said, quite honestly, if I didn't need your systems running the back end, you'd be gone.
They're on site. How big is this property?
It's only 121.
Okay,
only. It's 121 units.
But you had on site, like what?
On-site leasing center, maintenance, and then we had a kind of, they call it a floating leasing person.
Got it.
Yeah.
Yeah, that's good that you guys had on site because you were talking about some of the smaller deals you guys did early on, 28 units, 31 units.
Those are all off-site, yeah.
You telling me this story, it reminds me. So like one of our early deals was 32-unit building, Indianapolis. It had all the problems. It had hookers, prostitution. we showed up for the inspection and the cops were there like arresting some of the tenants. But it was in a pretty decent area.
Really?
And yeah, it was. Okay. It was just this property had all the problems.
Gotcha.
And so we renovated half the units, but we got into a position because, with 32 units, you don't have on site. And so, with those smaller buildings, like I think one of the biggest challenges is you're not dealing with institutional level property managers. You're dealing with a lot of mom and pop managers that might manage fourplexes and single family homes.
Right.
And so it's a little bit out of their wheelhouse. And so you're kind of in that no man's land where it's a little bit big for those kind of managers, but it's way too small for the institutional, more professional level managers. And so, those properties you got to get hands on, and we're out of state. We're like, fuck, occupancy dips down to like the high 60s at one point.
Wow.
And we're like, oh my gosh.
You're hyperventilating.
So what we did was we kind of reached a hybrid agreement with our PM to keep them on, but we said we're going to handle the leasing.
Yep.
And so we put out a job posting for like all the local realtors in the area that live within like a 2-mile radius of the property.
You did what I just did.
Oh, you guys did the same thing?
I love it.
Yeah. So so we did this. We found a local realtor, young woman who was kind of a hustler, and she was like, "Yeah, I'd love to." And we're like, "Hey, we're gonna pay you a flat rate each time you lease up a new unit for us.
Get a commission."
And then we went on Facebook Marketplace and Craigslist, and we just started slamming ads, Facebook Marketplace, Craigslist, to lease up our units. And then we would control all the leads that would come in,
the flow.
And then we would funnel all the leads to her, and she would follow up. She would schedule the appointments. She would do the tours.
So did you not have a PM software that was running kind of that syndication onto all the portals and stuff, or you did?
At this time, we weren't syndicating anything. This was we JV'd this deal.
No. I meaning in terms of for your available units. Was it out to like apartments.com, apartment list, like all the portals?
Yes, the property manager was. But we would like test them. And this is good for any listeners out there. Like if you have third-party PM, like send them a lead from like a random number,
see the response rate,
and see what the response rate is. And for them, it'd be like 5 days before you'd hear back. And it's like, whoa, that's not going to work. You know what I mean? So that's when we kind of took it in our own hands. But we got that thing leased up. We ended up renovating half of the units, 50%, and cap rates compressed. We ended up owning it for 2 years. We bought it for 1.1. And we exited exactly 2 years later for 3.1.
Good for you.
And
that's a good 2 times on that.
Yeah, and so that was kind of my first taste of like operating a multifamily deal in that kind of that range right there. But that is the management portion for those types of deals that are kind of from 20 to 80 units. It's very hard.
You have to manage the managers.
Yes,
and this is what I've learned. And quite honestly, look, it doesn't matter. And it doesn't matter how big or who the PM company is. It can be RPM, it could be Asset Living, it could be some other ones out there that are the big conglomerates nationwide. It's irrelevant. It's all about the people because they all have systems. They have their PM softwares, they got their payment processors, they have all their systems, it's great. But if you don't have strong people, your community manager, right, or the person that's offsite managing your property, right, and you don't have that person that's strong, and then if they don't have services in-house to handle the leasing and the follow-up and all that stuff, if you have an offsite manager, you're going to struggle. And that's why it's critically important if you're managing out of state that you set up the infrastructure in place in advance, which is what we did in all the markets. If we were offsite management, we met with a couple PM companies that were kind of mid-size that did a lot of that. So we didn't have the small little guys, but we didn't have the big guys either. But even then, I mean, we just had to do this, and I'm still doing it on the Texas deal because I'd been asking for a floating leasing agent for 12 months from this PM company, and they kept giving me, temp agent crap. And I said, guys, I'm going to show you how this is done. You want to see how this is done? Boom. Went to Facebook, went into the real estate groups, San Antonio, Texas. Within 7 days, I had an amazing leasing agent on site, moving like what, just humming. Boom. 7 days. I said, it took you guys 12 months. You couldn't get your head out of your ass. I did it in 7 days. That's just effort, guys. It's effort. It's unbelievable.
And you saved the $7 million of equity. And you mentioned you guys brought $2 million to the table to refi another perm.
5 originally, 2 more, so total of 7.
Okay,
correct.
And that's because the rates went up pretty.
Yeah,
pretty
we had to buy down the debt because Fannie Mae was only going to give us 63% loan to value based on financials, based on interest rates, debt coverage ratios, all these things that are important. And because of that, we had to bring in cash in. Now, thankfully, we did not over leverage that property going in the door. We only put 70% debt going in. Thank goodness. Because had we jacked it up like a lot of syndicators did, that $2 million would have been 4 or 5. And then most of the investors would have said, we can't. Like, that's crazy. It doesn't make sense anymore. And that's what you're starting to see happen. So there are amazing opportunities coming that I can tell you. Like, we just launched our opportunity fund, our $25 million opportunity fund, and we're going after this stuff because I know it's starting now. Through 2024, 2025.
So, and it's interesting you say that because we're starting to see deals shake loose on the hotel side. What is the opportunity fund that you guys are launching and what kind of assets are you guys targeting? Hey guys, real quick, the only way the show grows, the only way we continue to bring on bigger and better guests is if you guys rate, review, and share the show. So if you could take 2 seconds or the click of the thumb to review on Apple or Spotify, it will mean the world to me. But more importantly, we'll be able to reach more entrepreneurs and more real estate investors and help them build wealth through this podcast. Now back to the show.
Multifamily specific, dedicated towards really cash distressed assets where we can come in, pick up an existing product, right, that just needs cash infusion, take it over, and run it, right, at a new valuation. But we'll probably pick it up direct from the asset managers inside these debt funds. There's about 5 or 7 debt funds, big guys, that a lot of these deals, and they made these kind of riskier bridge debt, variable rate deals over the last 3 to 5 years. So I'm inside those guys right now, just talking to them, saying, hey, if you have loans or deals and problem properties in these regions, we're your people. Because it's not going to see the light of day. You know, the BlackRocks, the Blackstones, all these guys are going to gobble up the big stuff. You're going to get kind of the low-hanging fruit, but decent stuff. And that's how a lot of these kind of distressed deals, and then also construction deals where people have gone in, new construction, and they can't move it out of the construction financing and they need cash infusion to kind of come in, and you can take an ownership of something that needs help. Great asset, maybe great location, but it got caught up in all the interest rate pops. And they went through 11 interest rate hikes, right, over a, 9-month window. I mean, it's causing a complete show. And a lot of people are just hanging on for dear life and kicking the can down the road, hoping they can refinance in the future as rates drop. And maybe that happens, maybe it doesn't, but it's a very precarious situation in the commercial space right now. Very.
Yeah. We're doing the same thing right now. So one of the deals that we're picking up December 13th is through one of our bridge lenders, but they're like a big, basically debt fund. They're like a REIT, but they do bridge lending for all commercial real estate. And so they have, some stuff that's going bad, right? And so this particular deal they brought to us and they said, hey, we're taking this one back, but we think you guys would be the perfect operators for it. It last appraised for 7.5. We're picking it up for 4.87.
Beautiful.
And it's 2 years old and it doesn't require any reno, nothing like that.
See, that is like music to my ears.
Yeah.
I love that.
So I'm like, guys, like, we're busy right now with a bunch of other stuff that we're doing, but I'm like, guys, we have to pick this one up. And so I'm like, let's just be as easy as we can to work with. Let's make this one go smoothly, because when they have future stuff go bad, like I want to be the first to find out about it. So I love that strategy.
Well, and it works because the debt fund we just paid off on that refi, I won't mention who they are, but they were ecstatic. They were surprised that we actually were able to pull it off, and they were ecstatic. And they were like, Justin, like, wow. And then I said, well, it's been 2 weeks since we paid you off. I just wanted to ask, do you have any other bad loans that are on your books that you may need to have a discussion about? And so you get into the asset manager, and that's how it's going to get done. It's not going to the brokers. It's not coming on market. This is all going to be belly to belly inside these asset managers.
Do you think a lot of these bad multifamily deals that are, potentially going back to the lender, do you think a lot of these, or a good portion of them, will actually have some sort of capital injection come in, and the initial borrower is not going to have to give the deal up, but they might give up some equity to that capital partner?
I think you're going to have a combination of all the above, and it really depends on what does it look like? Meaning, how bad is your debt? How much did you over leverage? What's the valuation? Because cap rates are rising, right? So that's causing a massive challenge in some of these markets. So, what is the property worth? Does it make sense to come in with new equity and stack it? Or does it make sense to wipe everything clean and start fresh?
And come in at a different cost basis.
Correct. Because that's really the challenge, is the basis. Because, we all know everything because of low cap rates. And now in the short term, everything's dropping in value. Now, if you have good debt and you're fixed and you can just hold on for dear life, then hold on for dear life. Yeah. Because it's a holding game.
Well, it's not a great time to sell. If your property is performing well,
you're going to get murdered.
Right.
Yeah. So you might, even if you're not performing that well, but you can ride through it, because it's no different than if somebody came to me in 2008 and 9 and said, oh my gosh, I just watched my home value drop 65%. It's never coming back. I'm never going to see my value again. I'm just going to give it back to the bank. Well, I can understand why you would think that, but now that you've seen it, you know that it's coming back. It came back for all the homeowners, and then it's going to come back for everything else. It just may take 5, 6, 7 years. You may have to hold that asset where your business plan was 3, and now it's going to be 7, maybe more.
Yeah.
maybe more.
It'll be interesting to see though, like what happens next year. We got election year.
Yeah.
I saw an article come out recently. I think it was Forbes, but don't quote me on who put it out. But it said that, they're foreseeing rates to actually drop next year like 4 times what the market's actually pricing.
Yeah.
And so they were looking at like, basically early Q1 of next year, us to officially enter like in a recession.
Yep.
And for them to do rate cuts between Q1 next year to the end of the year, somewhere around like 2.25.
Yeah.
Which would be very significant.
It's possible. I mean, it's been so unpredictable, but it's going to come down to economic data. And at the end of the day, it's all about jobs, right? It's all about jobs, meaning if that job report is strong, they're not dropping rates. If the job report starts to get weak and consumer data starts to go south, they're probably going to drop rates. It's all about the jobs. That is going to dictate where we're going.
True. But I mean, initially they said the rate hikes were because of inflation. Now inflation's back down,
Yeah. I mean, the data's showing that, but they're still not going to drop the rates until the jobs go with it.
Yeah.
They're just, they can't, because the Fed's dealing with a really interesting situation where inflation or whatever's out there is actually helping them in some ways really mitigate their own debt. But at the same time, if they can't raise interest rates anymore, because then they're paying debt on their own debt, interest on their own interest, and it gets nasty. But right now they're going to stay right where they're at until they see some sort of economic data that gives them the indication that, hey, we need to come save the world again.
Yeah.
And then rates go.
So I'm curious, like as we look out for the next 12 months, let's say end of 2024, I'm not going to hold you to this, but where do you foresee like multifamily cap rates and interest rates, generally speaking, December of 24?
They're going to continue to go up.
Really?
All of next year.
Interest rates too?
No. Interest rates are going to stay right where they're at. I think we've peaked on that.
So cap rates will just catch up.
Unless you have some crazy inflation data, interest rates are staying right where they're at. And if anything, they will drop, but I don't think they're going up anymore. I don't think the Fed can. Like they're at that precipice where it's like.
Got it. So you're saying cap rates are just going to catch up to their rates? Correct.
Got it. Because you're still having that delta between what sellers want and buyers can pay and blah, blah, blah. But it's going to take time for that to filter through.
Yeah.
Yeah. Because right now, even in, for even new construction stuff, you're seeing caps at 6% in some markets, 6.5% in some markets for Class A new construction. And then other markets, if you went into Texas, you may see temporarily cap rates at 7% that were previously at 4.5%. I mean, it's jumped that much. Now, I'm not even looking at those right now because it'll make you go sick to your stomach on how temporary valuations are on some of these buildings. But if you have decent debt on your property and you can hold, you just hold through it and you'll be fine.
Yeah. It's funny. There's a lot of operators that are probably kicking themselves right now because they had an opportunity to exit in like 21 or early 22 for some absurd number. And they're like, we're going to hold a little bit longer. And now they're like, oh, shoot. But then you also have some operators that literally sold in early 22 right before the rates went up. And they're just like, oh my gosh, thank God. Tyler Devereaux out in Maui, he was on. He was telling me
he's a good dude.
Very good dude. I love Tyler. Yeah, Tyler's a great dude. Doing some big things out there in Maui, and I've always been like inspired by him. Like just a good dude to talk to, positive and just growth minded.
Yeah.
He actually invested in our boutique hotel fund. But dude, talk about a great human being.
Yeah, he's got a good vibe. I went to his multifamily mindset out in Vegas a couple years ago.
Okay.
Got to meet with him and some folks, and very sharp, good human being, good vibe, good energy.
Dude, I talked to him last couple weeks ago, but he told me that he broke up with his partner. They broke up.
Oh, wow.
It's crazy, right? Because they have a lot of stuff together. I mean, just on the ownership side, but also with the mindset stuff or the mastermind. So it's funny because like on the podcast, we're having a conversation. He was asking some questions about partnerships and all that. And then talked to him 2 weeks ago. He's like, yeah, he didn't break up with him, but his partner said, hey, I'm not going to do this anymore. He's like, I'm going to hang it up and call it a day. So obviously Tyler is like, he's going to keep this thing going, but so he's going through a lot of like restructuring right now.
Mm-hmm. What do you do? Do you have a morning routine? Like, how do you handle kind of mindset stuff? I'm always curious about how people handle like their daily activities, even meditation or, the mind game, right? Because it's so much of what we do every day as entrepreneurs.
Dude, I got to be honest with you, man. Like, I don't do a ton of like morning routine stuff. So I'll tell you what I do. I wake up and...
What time do you wake up?
I usually try to wake up at 7.
Okay. God, you get to sleep in a little bit.
Yeah.
That's good. I wish I had that.
To me, that's not really sleeping in.
To me, I'd be like, holy cow, it's
Yeah.
noon.
Because if I'm in bed by 11:30 and
Yep.
I'm up at 7, that's
Okay.
7.5 hours.
That's good.
If I'm in bed by 10:30, that's a really good night
Yeah.
right there. But anyway, so yeah, as you wake up, first thing I do is I go straight to the gym. I don't try to open my phone or anything like that. I'll drive to the gym. I'll get a good workout in, come back, shower, change, and then I'll walk into the office. I'll grab a little Starbucks on the way in and come to the office and just jump right into it. They always say, like, you should, the most important things of the day you should do first. And so for me, the most important thing is taking care of my body.
Yep.
And so that's why I try to go out and work out first thing in the morning. In the afternoon, if I don't get my workout in the morning and I try to go after, a full day in the office,
Are you
I
suffering?
just have so many more excuses not to go. But also, like, the energy and the vibe is different in the gym at that hour. It's like you go in the morning, like the people in the gym are like, they're there because they want to be there. They're getting after it. And there's a whole different energy. And then you go in the late afternoon or evening.
It's like people that are pissed off.
Yeah, people are kind of dragging their feet. They're there because they have to be there, right? And so, anyways, that's what I kind of do, and I jump into it. I would say, like, work weeks wise, like Monday we do a ton of meetings. We do our level 10 meeting in the morning, and I jump into like a lot of one-on-ones. I do a call every Monday afternoon with my business coach, and Tuesdays more meetings and stuff like that, and then we have our mastermind calls for Tuesday, Thursdays. Wednesdays are always content days.
Okay.
So we'll do 2 podcasts, sometimes 3 podcasts on Wednesdays. And then Fridays, I just kind of like leave open. I try not to schedule anything on Fridays. And it's just kind of a day for like thinking or whatever things I want to do on Friday, I'll do. So
have you read that book, Atomic Habits?
No.
By James Clear?
I've heard of it.
Incredible book. I'm about halfway through it right now.
Okay.
But it talks about, mastering your morning, master your day, and habit stacking, and like these other things that if you either want to get rid of bad habits or put some good ones in, and how you specifically do that. I mean, I can't even summarize it right now, but I tab all my books, right? So that way, if I have to go back through them to pick up a piece of info, it wasn't just like I read an entire book and then I think it's going to stay here. So I actually will tab and highlight areas that I was curious in. But incredible book. So I started doing that habit stacking. That's what they call it, meaning I will wake up at 5 a.m. After I wake up at 5 a.m., I will make my bed. After I make my bed, I will do 10 push-ups. After I do 10 push-ups, I will go downstairs and make coffee, right? So you're habit stacking these things in line with other things you already do. So that way it'll naturally fall versus, if it was something you didn't like, but you needed to do, you try and habit stack it. So it'll fall in line with what you're already doing in your normal day. If you actually were to track what you do in the morning and then try and sit something in there, because it takes 67 days to actually instill
a habit.
A real habit. Yeah.
What does the book say about having a morning routine past making your bed and making a cup of coffee?
Well, it's incredible. I set because my biggest thing was if I have a great morning, like setup, even before kids wake up and chaos starts and all that stuff, any parents can speak to this, having that about an hour to maybe an hour and a half if you're lucky, which is why I wake up at 5 a.m. Kids wake up at 6:30. I need that hour and a half to kind of get moving, do what I need to do a workout, coffee, meditation, listen to affirmations, all these things that need to happen. So that way my energy's in the right position to then deal with these little beautiful souls and get them to school and deal with that. And then before the business chaos starts, because if I'm waking up any later than that, then emails are starting, texts are starting, all that stuff's already blowing up. And I need that hour to kind of get set before I feel like here comes the world for me. And that's helped tremendously.
Yeah, so that's good. I know everyone has like their things that they're into. I tend to side more with like that Alex Hormozy approach. And he basically says like, he likes to just, he's very extreme, but I'm not that extreme, but he just wakes up and starts working. He just jumps right into it and goes. I like to. He doesn't
have kids yet.
No, he doesn't have kids yet.
I guarantee
he doesn't have kids yet.
I guarantee that changes when he has children.
So he'll get it. He says he gets up and literally just starts working.
Yeah.
And he'll work. And then like sometime middle of the day, he'll go to the gym, take a break, and then come in and work in the afternoon. But I like to wake up and literally I just, instead of opening my phone and all this BS, making coffee and all that, I literally just brush my teeth, put my workout clothes, and I'm out the door.
Yeah.
I don't even eat before I go to the gym. I just bring a protein shake with me and some water,
So
some electrolytes, and that's it.
Yeah, you know what I had to do to stop looking at my phone? One of the first or two things that people do when they wake up, right? Right, is, this goes to the Atomic Habits book, is you want to attach something that you typically do that's not good for you, but you do it because you just want to do it, to a reward. So you would say, I can't look at my phone until I do this. So you actually complete those habit stacks. And then by doing that, then I can go, now look at my phone. I like
that.
Look at my social media real quick.
Yeah.
Or scroll through pointless stuff.
Yeah. I don't look at the phone because I know if I just get out the door and get over to the gym, like, okay, now I'm going to get my workout
100%.
in. Once I'm at the gym, I'm not going to open my phone and get in this whole, like, digress thing. But like, you open your phone sometimes, it's like, you got, like you said, you got texts, emails, all this stuff. There's always problems, fires you got to put out as an entrepreneur. You know this better than me. And, for me, I'm like, I like to attack things right away when I see them, or be responsive and stuff like that. So for me, I'm like, let's just wait, get the workout in. And then when I get in the office, then I start.
Well, yeah, because if you start scrolling through your phone and emails, it becomes a barrage of like a hole. So 100% with that.
What works best for you in terms of like the mindset to like go take on something that's maybe you're going to push your comfort zone? Because we've all been there. Like, the first time I did my first deal, I was nervous, right? It was overwhelming. And, those smaller deals that I did early on, or that condo that you did as your first deal, like that thing doesn't scare you anymore. But, I'm sure you're doing stuff now that's like, okay, it's pushing the comfort zone a little bit. What kind of techniques work well mindset wise to get you prepared to go take on something that's going to make you feel uncomfortable for a period of time?
Yeah, so this comes down to personality traits. This is actually a great lead in for somebody that kind of fits this personality. So when I did my DISC testing, so that's by Tony Robbins, I was a CS, right? So C is you're hyper analytical, organized. You have a plan for a plan and a plan for that plan, right? So that's great, except you can also get caught up in paralysis by analysis. And then the secondary was the S. That was like the soccer mom. So I'm sitting there going, wait a minute. So I'm analytical and I'm a soccer mom? That's not going to work, which means I'm great with customer service. I'm great with people, but then I avoid risk. I like no change. I like consistency. Don't move. Just keep even Steven, right?
Sure.
But if you have analytical and organized with don't take any risk and stay steady Eddie, you might as well just go get a cubicle job because you're not going anywhere. Like that's where you need to be. And I was like, well, that's not where I want to go. So I honestly had to start manipulating the second one. And I moved, the C's there. That's not going to change. But the secondary is now a D. That's the driver director, which means we got to go. We can analyze all we want. We got to get to the edge of the cliff. And we can say we've done all the analysis we can on a deal. We've looked at the risk. We've, call it, calculated risk. But then you get to the edge of the cliff. You got to go and allow the how to show up. You got to go and allow the how to show up. And it will, especially if you're a go-getter and you're a doer and not a dreamer, the how will show up because it has to. Because you'll get into something and you'll be like, oh crap, it happens all the time. And you will find your way through it because you'll just fight. So that has to be in there. And so that D inside of me was the one that made that happen. And once I gained the confidence in going through that once or twice and realizing that every broke person was rich. I'm sorry, I take that back. Every rich person was broke at some point, right? You can take everybody, whether it's Grant Cardone, whether it's some of the billionaires, the Elon Musk of the world, they were all broke at some point, right? Jeff Bezos broke in a garage at some point. And they just had to push. They had a dream, they had a vision, but they made it happen. They were a doer, not just a dreamer. Because my dad would always say that. He'd say, listen, there are two types of people in this world. There are doers and there are dreamers. Dreamers, will just dream, but doers, they'll take their dreams and make them a reality. That's the difference. Doers will take their dreams and make them a reality, while dreamers will just talk. They dream. They're the ones that say what they're going to do all the time, but that they never execute. And it's typically because of fear. They get to the edge of the cliff and they walk themselves back.
Fear of the unknown.
Yeah, they allow, this is another thing I had to learn through psychology, but you have the frontal cortex and then you have this thing called the oblongata or whatever it's called here in the base of your spine. In your human biological brain, when you go towards anything, it automatically wants to stop you and protect you. That's this here. And it's usually bigger than this. So when that's happening, you have to basically say F you to this thing with your frontal cortex and you got to go.
Yeah.
And that's usually the difference maker. That's what's gotten you to where you're at. That's where Grant Cardone's gotten to. mean, his story in San Diego is incredible. We were chatting about that before we came on, right?
Yeah.
But his first 2 deals were here in San Diego. He's from Louisiana, did some house flipping and rentals in Houston, moved to San Diego, was living on Camino de la Costa in a house, and this was in the 90s. Ended up walking across the street one day. There was a house that was not even on the market, waterfront. He ended up looking over the fence, met a broker that was going to shop this house, and he ended up buying it off market for $4 million and change, flipped it for $9 million and change, and that was his first big chunk of money. And then he met with a bunch of people here in San Diego. One of them was Rudy Medina, and he was with Marcus and Millichap at that time, but then he partnered with Grant on his first 2 deals.
And one of those 2 deals was the 37 units in Vista that he talks about?
Correct. He had the Vista deal and then Point Loma.
Gotcha.
And then they did those deals, did well. And then, Grant ended up going off and doing stuff in Arizona. And then obviously Grant's Grant, right? And it's wild to watch. And I love it.
Yeah, that's crazy. There's a good quote out there that says, if you have all the information to do the deal, you'll never have the deal. And it's so true. And like everyone has a different level of risk tolerance.
Yep.
And, I used to have a couple partners. And one of the main reasons I decided to go on my own is because we were just not aligned in terms of level of risk tolerance and having the confidence to, push past certain things. And so I just felt like I was never going to reach my full potential.
Yep.
Working under that structure. And so, I think it's okay for everyone to have a different level of risk tolerance. But, to me, and I'm sure for you, like a lot of the stuff that, looking back, a lot of people might think is risky, but, in all reality, as an entrepreneur and as a real estate investor that's growing, it's like, to me, it's not risky because I know that, when things go south, and they will go south with every single deal, that I have the confidence and the team and the resources to come up with a solution and push past it, right? And so there's always going to be unknowns, but, and it is scary, right? But
what would you say your biggest fear is?
Well, it's funny because like looking back, it was like, my first deal was an 11-unit building in Cincinnati, and I cashed out my 401k to get it, and everyone told me it was too risky, I would say my biggest fear looking forward really is the fear of regret. I don't want to get to.
I knew you were going to say that. And you know why? Is because they ask anybody on their deathbed at 80 years old, what is your greatest thing? And they say, regret that I didn't do this, regret that I didn't do that, regret that this, right? Like my biggest fear is literally myself now meeting my 80-year-old self and having to tell that 80-year-old self, dude, I'm sorry.
That's so
that I didn't freaking go for it.
That's so good.
And you hear the quotes all the time. You see them on social media, right? Your biggest thing is not going for it, right?
Well, dude,
or staying in the same place this year that you were last year, or
And that's even if we make it to 80. Like I just saw saw an article recently that said the life expectancy age for a male in the U.S. has actually dropped from like it was like 77. It's dropped from like 77 to 73.
I feel like it's going to go up with all these weird things we got going on.
Yeah. 73, man, that's not too far away.
But 1 in 4 are getting cancer. I mean, it's. I'll be willing to bet you there's amazing podcasts and there's amazing things on it about the food supply system.
Yeah. Well, dude, Justin, I appreciate you coming on, man. Where can listeners get in touch with you?
Go on Instagram, I guess, man. That's probably the easiest way. If they want to follow it, you just put in Justin C. Brennan, and it has all our contact info there. And love to be resources for people, and just give back as much as we can.
And you're going out to Cancun, is it tomorrow for Ryan Pineda's mastermind?
Yeah, I'm stoked for that. I'm getting on a plane and heading down there tomorrow morning. Ryan Pineda's got a kind of a mastermind retreat for the end of the year that I got into. And
love Ryan.
Play some golf and
tell him I say what's up.
Chat about some good stuff. So I'm excited.
Cool, dude. Well, man, I appreciate you. He's Justin Brennan. I'm Rich Summers. Listeners, thanks for tuning in. We'll see you in the next one. Peace.